What does equity mean and how can we use it? Many successful property investors monitor their portfolio annually. They take note of their income and growth returns and look at what equity is available to expand on their existing portfolio. Many first property investors become complacent to owning one as they have limited resources to professionals to help them. In this podcast, we take the opportunity to explain what equity means and how you may be able to use it. What is equity? In short, it's the difference between your property value and what money you owe on it. To elaborate, if you own a property value at $850,000 and you owe a mortgage worth $150,000, you essentially have equity of $600,000. That is $850 take away $150, leaving you with $600,000. What is available equity and how do you find out? The most appropriate way to calculate how much equity is within your property is to have it valued by a bank or lender. Once the bank has valued the property, they essentially allow you to borrow between 80 or 90% of the property value. This is also known as a lending variable ratio, being LVR. Taking the earlier example, if the property was valued at $850,000, the bank will allow you to borrow $680,000, being 80%, or up to $765,000, being 90% of the value. This will be subject to the bank using the property as security. Now, we aren't elaborating further on lending mortgage insurance, but if you do borrow more than 80%, you would be paying lending mortgage insurance. If you're not quite sure what that means, please feel free to go to our website at www.crestproperty.net.au, and under the section Market Insights, you'll see some great useful information on what lending mortgage insurance is. After determining the valuation and the LVR, we can now calculate how much equity can be used to expand on your property portfolio. This is also known as available equity. If we proceed with an LVR of 80%, we are able to borrow a loan amount of $680,000. As the property is already mortgaged at $150,000, as the example we've held earlier, you essentially have available equity of $530,000. So the way to calculate that is the property value being $850,000, take out the maximum 80% loan of $680,000, take away the current loan of $150,000, leaves you with available equity of $530,000. If you can't visualize what all those numbers are, feel free to go to the Market Insights area because there is a great article specifically on what does equity mean. Understanding your equity helps you make better decisions when sourcing a property. However, it doesn't mean you need to use all of it at once. As a result, ensure you invest within your own affordability. What is good about available equity? For most people, buying property is a priority in some stage of their life. However, obtaining a cash deposit can be very challenging. Saving for a cash deposit is often reduced as the property market generally increases by more than your own savings account. This is why identifying your available equity is very beneficial. It consequently fast-tracks your ability to buy another investment property. The hardest property purchase is generally your first. You are often restricted to contributing cash as a deposit rather than equity. Do all properties accumulate equity? Over the long term, most properties provide capital growth. However, not all properties accumulate in value equally. Location is no cliche. Location has a great deal to do with accumulating capital growth and in turn available equity. Therefore, better property selection can provide more equity sooner in advance to buying your next one. Are there any other ways to accumulate equity? Well, yes, there is. If you maximize your cash flow, you can reduce the mortgage faster than just meeting the minimum loan repayments. By reducing the loan balance, this will accumulate available equity, even if the property does not grow in value. It comes down to how dedicated you are in paying that loan down faster. That will result in further available equity. If you take advantage of reducing your mortgage and property appreciation, you'll access a greater level of equity in a shorter time frame. What should we buy if we have equity? Look, in summary, the answer will differ for everyone. Before expanding your portfolio, you want to be sure that you can afford the next property. If we take the early example into consideration, having equity of $530,000 can be spent on buying one property or potentially two. When buying a new property, you'll be able to borrow against it using the new property as security too. This is where you should obtain advice from a mortgage broker and financial planner. Having $530,000 can be quite exciting, but you still need to make sure you don't over budget. Some buyers may also consider using half of their equity to buy a property and use the remaining later. If you'd like to learn more on what you're able to do and how you'd like to expand your property portfolio, please don't hesitate to contact us. Visit our website again at www.crestproperty.net.au. We'd be more than happy to help and further educate you on your property journey. Thank you.